Hi, everybody. This is David Skarika. So this is our 3-for-1, our weekly stock chart of the day, our stock charts of the week, where we'll talk about a bunch of different things. And this will be eventually just for the paid Patreon members. So usually I'd put this out and the regular stock chart of the day out on the weekend, our weekend versions. Well, because, they'd be for two different kind of people, before some people for the free subscribers, some people for the Patreon members. But the Patreon is not going to be launched till this week. So what I'm doing is I'm putting this out on the Monday, October the 2nd. And the free one is kind of a lead in where I talked a bit about, you'll see I talked a bit about gold seasonality and the like. So what we're going to do is we're going to look at that, but now we're going to look at more in depth. So I guess I was calling it a 3-for-1. I don't really want to call that because in case I want to talk about more, but I also want these to be concentrated in terms of, I don't want to go, talk about wheat or oil and soybeans and then talk about gold, silver, S&P. So I'm going to really try to keep it to 3 or 4 themes, and my kind of all over the place themes talking about everything macro. That's for the lifetime members, which I do and try to do once or twice a week where we'll talk everything again from wheat to soybeans to gold, silver, S&P, foreign markets, stocks, etc. So today we're going to look again at that gold seasonality, but we're going to look at it in 3 things. We're going to look at gold, the US dollar, and interest rates, and what has to happen for gold to turn higher, gold and silver to turn higher. I'll look at silver as well. So let's get into this right now. So this is gold right here. We talked about this. So we're going to get right into, we're going to go back to, last time we looked at, we're going to go back actually to, we'll go back to 2000 and the beginning of kind of this gold bull market, et cetera, et cetera. So we're going to look at the end of the bear market in gold in 2000, and then the bull market. So this was in 1999. There was, you can see the seasonal low a little early, but if you had bought that here in 1999, there was this big surge higher. I think some of this was over Y2K or fears, but again, gold had its typical seasonal low, and then grinded lower into late 2000s, and then it moved higher into 2001, 2002. So what were these things happening here? And again, you see 2001 had started again. Gold had this low here, and again, you can see the seasonal move. Gold had a little correction in 2002 and another seasonal move. So we can see that happening over and over again. So what happened here, that gold had its final low in late 2000 and 2001, and the gold stocks, their final low in late 2000. We'll look at gold stocks here. You can see they bottomed here. And again, notice like clockwork, always. October, November, October, November, October, November, and the rallies start, right? So why do the gold stocks kind of have this move lower and then move higher? Well, the first thing on the move lower and higher was interest rates. Interest rates were trending higher all the way through 1999 and 2000, and gold kind of went counter to that as rates. Remember back then inflation was only like 2-3%, and at interest you can see you had the short-term treasury over 6%, so you had real interest rates at 3%. Even now inflation is 3-4%. Interest rates are what, 5.5, or they're reporting at 3 and 4. We know it's higher than that, but let's just say what they're reporting. So your real interest rate is lower. But when you're getting real positive interest rates, that is usually negative for gold and precious metals. And then also in that time frame, into 2001, the U.S. dollar. Oh, sorry, we have to go USD because UP did not exist then. The U.S. dollar, you can see, was very strong, 99, 2000. So gold usually trades counter the U.S. dollar. So it went lower, and then the U.S. dollar began to top out as we get a longer term chart here, and you'll see, and gold really began to move higher in 2021, and really in 2022, 2023, as the U.S. dollar really rolled over. You can see this big topping formation, which took quite a while. It took from basically the middle of 2000 to early 2002. It took about a year and a half to form, and actually didn't break. It took about 2 years to actually break to the downside. So that's it. So what do you need? You need interest rates to stop going higher. You needed the U.S. dollar to roll over, and the seasonality helps. That November, December, that whatever October to December period, where gold and gold stocks usually bottom. But again, I think it's interest rates and the whatnot that's key. So now we're going to move into the mid 2000s, and there was a gold correction. This is the U.S. dollar. I'm going to see here, but there was a gold correction in 2004 and 2005, and what we can see here, I'll see here, 2005, actually 2004, and the stocks really corrected because the Federal Reserve, again, was raising interest rates in 04, 05 after, you can see here, all through 04 and 05. So, and then in 06, things began to flatten out. So again, we'll go a little further here, 06, 07, and you can see 06, 07, the interest rates begin to flatten out in middle of 06, and then really start going down in 07, 08 during the financial crisis. And what happens? Gold really begins in the middle of 06, even though it did have a good move in 05, 06, but again, interest rates were starting to flatten out here. But you can see the real huge move that happened when these rates went, were cut and went down here. So, and I think a lot of this move up in gold in 05, 06 was an anticipation that rates would stop going up. And then when they stopped going up, there was a bit of a consolidation, and again, boom. But again, look at this seasonality, like on par, right? October, November, October, November, right? Even though this was just a small correction, October, November, right? And then again, when they started to reverse rates, look what gold did. Now, gold crashed with the financial during the financial crisis with everything else. But again, look what it did. Gold really took off and was about the best performing sector. And if you go look at it, we'll go look at the gold stocks as well. The gold stocks are about the best performing sector until the summer of 08, before everything rolled over. From this low here in July of 08 to the summer of 08, we'll go quickly look into the summer of 08. Gold was stocks were about the best performing sector. You can see the HUI went to 500 from intraday low about 280. So almost doubled in price, went up about 80 to 90%. So, so what we want to see is the Fed really beginning to slow down the rate hikes or end the rate hikes and then go into an easing cycle, so as well. So now we're going to look at 08, 09. And what we'll see in 08, 09, we'll see the crash, and gold stocks crashed with everything, even though rates went down. But that was just because everyone kind of got a margin call and had to sell everything. I've even heard that this week there are some pension funds who are in trouble. The higher rates are really starting to hurt them. And and first thing that kind of sold was their gold as a way to do that. So that's, that's the problem when you're in liquidations. That can happen. So we can see rates here went to zero. But look at rates. One reason the gold led in 08, 09, 2000, rates were basically zero. They were cut down to zero. And then I know that this is, shows it, but like that's why gold led the US dollar in that same time period. You can see it did have a little run in 010, but basically, had a big decline in 09 after the big run during the financial crisis, and then fell into 0011. And by the way, that was one problem. That was, even though rates stayed at zero, one issue with gold from 2011 during the 2010s. The stock market also plays a role. When you get the stock market starting to be frothy, people go into risk assets to get out of gold. But that was one issue, that the dollar bottomed in 2011. So, and if we go look at the 10-year bonds, you'll really see it. Again, notice the 10-year bond kind of trended lower all through, like, basically, from early 2009 into 2011, 2012. And that also helped gold and gold as stocks as well. And we go look at the HUI. And again, off that loosening cycle. And remember, there wasn't just interest rates in 2009. They started QE here. So in that first move, off the lows, you see gold stocks, let's say they started the QE when the HUI was about 250. The HUI went up more than 100%, much better than the market over those next 2 years, right? Again, early on in the loosening cycle, this time it was more QE than interest rates. Gold and gold stocks outperformed. So let's look at the next gold stock bottom back in 2016. So again, you can see gold was trending lower. The dollar had been strong in 13, 14. And the Fed started to raise interest rates here where they did one rate hike. But then you can see this kind of bottoming in the HUI, and boom, this huge move over the first half of 2016. And if we go look at gold itself, the same thing, this big move. I think the US dollar, if I'm right, yeah, you can see the US dollar had this huge move with shit gold in 2015, 2016. A small move lower, and that really helped. But even that small move lower really helped gold and gold securities. And again, we look at short-term interest rates. You can see after that rate increase, they basically went flat during the first half of 2016. And again, let's go back and look at gold. Just interest rates going flat over those 6 months, gold had a nearly 25% increase. And the gold stocks went up even more. The gold stocks went up, almost 3x, from 100 on the HUI at the low to about 280. Okay. So now we're going to go to 2018. Look, not all these are going to be exactly the same. Sometimes the dollar has stayed stronger, sometimes weaker. But I really think the key is more real interest rates and the Fed and what they're actually doing, right? And you'll always see when the Fed goes into a loosening cycle, or at least stops tightening, gold outperforms. Like again in 2009. Okay, you could say rates were zero in 2008. That was a mass liquidation. That was a once in a lifetime kind of thing. But in 2009, it wasn't. It couldn't cut rates anymore. But the key in 2009 was they went QE into 2011. So, and you were coming out of that economic cycle, and that's also key. I don't want to get into that much here, but again, people are still kind of averse to the risk in early on in the economic cycle, so they go again into gold in that early loosening. The problem with the mid 2000 teens was we were 6-7 years out of a recession. People were kind of getting greedy again. They were going to tech stocks, going to whatever, and they didn't want to be in gold and precious metals. So this is gold here back in 2018. Again, in 2018, the Fed was tightening. And look what HUI did. The HUI went from 200 down to about 140, went down 30%. But then the Fed began to loosen, and then boom, rates back to zero during COVID, more QE. The gold stocks went from 130 to 360. And again, went up early on in that rally. Gold really underperformed during the frothy part of the rally in late 2020 to late 2021. Why? People wanted crypto. People wanted meme stocks. People wanted all these other crazy sectors, technology, et cetera, et cetera. So gold kind of got put on the shelf because people were like really frothy and really greedy. But again, early on in the cycle in both 2019, and then there was, again, kind of like 2008, a short-term sell-off here, and into the first few months of the rally, about 6 months of the rally, gold and gold stocks did very, very well. And I know because a lot of my juniors did very, very well as well. We had a stock called Aftermath Silver. I'll show you actually it right now. Aftermath, we did an 8-cent financing here in 2019. You can see here at 90 cents. It actually eventually went to $1.50. A lot of these kind of stocks did very, very well during that time. And then in 2021, we had a stock called a Newfound Gold. I've talked about it, go from $1 to $13, et cetera, et cetera. A lot of the financings did very, very well as gold turned up. But that's for another day. Here we're just talking about the macro cycle. So again, we're going to look again at that period, and interest rates won't really show it. Well, actually, they'll show it a little bit. You can see again, gold interest rates top. Gold and gold stocks start moving up in 2019 as they flatten out for about this 6-month period. They begin to cut over the second half of July, and then of course it goes to zero. And gold is absolutely fantastic during those 2 years. So I think we're right here in the cycle, or like you saw in 2020, or 2006. We're in that cycle where now interest rates are probably going to top out in the fourth quarter, kind of like they did in 2018. We're 6 months into like kind of maybe, unless the market really falls apart this year. But if it doesn't fall apart, and just kind of grinds lower, we probably won't see interest rate cuts to next year. And then we'll start seeing them over the second half of next year. I never expect interest rates to go back to zero. But of course, if we enter a recession, if things kind of accelerate to the downside in the economy, we will see the rate of interest rate cuts pick up. Rather than probably small quarter point cuts, the Fed might start doing, a couple half points or even 75 basis points, et cetera, et cetera. And again, if you look at the 2020-18 period, we go look at the US dollar. Actually, see here, this is where it's not perfect. The US dollar was actually, it bottomed here, and then they rallied and actually kept rallying, but then fell in 2020. So the US dollar is probably the least important of the indicators because gold can rally with the dollar. That's happened in the past. It happened again in 2019. But again, what you really want to see is interest rates top out, flatten out, and then cut. And gold and precious metals coming out of that will really be the strongest sector. And if we get a recession and bear market, then it will really be the strongest sector because people's risk tolerance will be way lower. And early on in the reinflation cycle, people get into gold and precious metals. And I talk about this in my new book at length. I use the actual numbers, et cetera, that I've just showed you of all the multi-100% increases in the price of gold and gold stock. So like I said, and I'll have more ideas on the juniors, more ideas on seniors. But like I said, we'll talk about those in the coming weeks. I don't think there's a big hurry. I got actually another 2 companies I'm going to talk about this week that are sponsor companies as well. I don't think there's a huge hurry because I think, we're getting tax loss selling season. We're still in this seasonal time where it's weakness. I think gold could still go down, another $100 to $150 from here over the next month to month and a half or 2 months. But I think you can see here, it does look like we're kind of seeing the scenario where, and again, let's look back at a long-term chart of interest rates just as I end off here. Yeah. So again, let's go even longer. Let's go back to the 90s. And you can see here, actually the same thing even happened here when they began to cut rates in 95, 96 from like 94, early 2005 to 96, 97, gold stocks did fantastic. Again, early on in the cycle. And then they really lagged as again, the dot-com boom. But again, a boom happened. So you can see here, this in the rate of the short-term bonds slowed down in late 2000. They began to cut rates and then down. Again, you see here, they stopped raising rates here. And go down. Yeah. Yeah. Okay. No problem. And then the rates here, what that topped out and then went down. So I think we need the rates showing signs of topping out, which I think we will see now in 3 to 6 weeks, and then rolling over. So, and then that's what we'll see going forward. And then I think that's when you'll see gold and precious metals kind of really start to perform. If we look at gold here, you're going to see here, again, as those rates kind of topped out, boom, then up. And then same thing in that 2006, 2007. We're showing these all in the short-term chart. You don't really need to see them here. But again, that's what you really need. Okay. So I'm going to leave it here and that's it. I'm going to stop it at that and that's it. Okay. I think that this is enough. We've shown you this overview. So I hope you get a good macro feeling for it. A lot of times you have to be patient with these things. One reason I haven't been, and on my marketing side of my business, I consult out other third parties to help market these companies. We usually do a company a month. We didn't do any companies over the summer. We only did a very small contract with Carlisle in September, and the stock did well. I'm looking at getting one of these other deals in for November. I'm not going to do a company in October. It's just because the market is dead right now, and I don't think it's the right time for it. And look, I don't want people. I think people need to be patient as well. So I don't want to be pushing companies marketing. Hey, and I can make more money short term doing that, but it's not worth it because ultimately this is what we're going to see. We're going to see at some point this move up. Okay, so yeah, Okay, and I'll leave it at that.